Money, I see some of the familiar faces in the audience, and many of you know and love talking about money. Glad that you're here. Uh, we are excited about this second session that's going to build on the first session. But before we start, I would ask that you all indulge me for a moment. I want to actually uh, ask for a moment of silence, a 30-second moment of silence for all the Black lives who have been lost through the hands of hatred and ignorance. So if you would just bear with me for a moment, that we can pause for a moment, a 30-second moment of silence. Thank you. Thank you everyone for indulging. We also want to just send love out to all the victims out there of natural disasters that are happening in our nation and the world. We're actually, we have fires going on in California, hurricanes relentlessly hitting our South. And we have so many things to be thankful for. So, in these trying times, it's so important that we press on with awareness, perseverance, and with gratitude. So I just wanted to take some time as we're talking about money and we're talking about opportunity and persevering as entrepreneurs and creating opportunities. We have to be aware of some of the things that are going on in our nation that we have to be aware of. So just before we get into it, I wanted to make two very quick announcements. Uh, Many of you on the call, or some that are not here that will see this in the recording, have applied for the grant, the COVID recovery grant that Minority Business Alliance and United Way partnered to disseminate and to grant 5 awardees either a $10,000 grant or 8,750 if you're not already a Minority Business Alliance member. That deduction of that from that 10,000 will cover 5 years of your membership for the Minority Business Alliance. The update on it that I wanted to share real quickly is that we'll be working with the United Way team and actually going through the decision-making process, and with the hopes of awarding or deciding who those 5 awardees will be by the end of this month. That's the ideal, that's the plan. So just wanted to let you all know that have applied, that may not have heard anything from anyone. The second item, which is usually what we'll talk about at the end, but we got so much good information that we're going to share today with you all, is that our next Minority Business Alliance meeting is October the 27th, and it's going to be with Fran Harris and Ann Thompson, 2 very good friends, and they'll be talking about scaling your business. Scaling your business, what it truly means, what are the mechanics of it, and is it for you, is it not for you, and thinking bigger, and how do you think bigger and creating wealth with your business. So very excited about that as well. I'm so glad that in my absence, you all have touched on the kickoff question and shared such prolific names. And so now I wanted to give you a quick framework of what our presentation is going to be today. I'm going to introduce our presenter, but what he's going to be doing is sharing 4 critical components of the bank loan process. I know I've been turned down for a bank loan before. I'm pretty sure someone else on this call, on this conference, has been turned down before and has gotten a no, but without a whole lot of in-depth information on why you got turned down. So we're excited to have uh, our partner, someone who is actually serving as a sponsor for our financial series in Blue Ridge Bank, to share with you all the blueprint. Not only you receiving a no and a nice letter and go for it and try again, but actually digging down into why you got turned down, but then what are the next steps and what you should be doing and what is the strategy that you should be taking to get to yes. So I encourage everyone that's on the call that's intrigued with this to get your pen and paper out, because there are going to be some copious notes that you can take, because we got the inside track on how to get to yes. So let's take advantage of it. So let me introduce our guest. His name is Daniel T. Moskowitz. For the past 23 years, Dan has been working with businesses to help them finance their operations and growth. He spent the first 16 years in the big bank space, holding relationship management and leadership positions at First Union, PNC Bank, Wells Fargo, and SunTrust before leaving for community banking. He estimates that he has worked with over 2,000 businesses over these 23 years and has lent hundreds of millions of dollars in that time. But banking is his second career. He was an entrepreneur long before he was a banker. In fact, Dan bought his first business at 21 years old, just 6 months out of college, and operated it successfully for 10 years before selling and beginning his banking career. His time on the other side of the table has given him a rather unique perspective on the banker-borrower relationship. Today, Dan is the market president for the Blue Ridge Bank here in Charlottesville, and he and his wife Karen lives in Lake Anna, where they built their own home. They have 3 children, 26, 24, and 17. As Dan presents and tackles these 4 critical topics, what we'll be doing is taking a break between each topic to solicit your questions. So as always, post your questions in the chat box. Our Vice Chair of Finance, Alex Erpy, will be monitoring your questions, and we'll answer the questions appropriate to the critical component that's being covered by Dan. So without further ado, let's give a virtual applause for Dan Moskowitz. Dan, you're up.
It stinks when everybody's on mute. I can't hear the clapping. That's not fair. Thank you, Quentin. And good to see a lot of you who I haven't seen in a while, but we've known each other for many years. Some recovering bankers out there and some current bankers waiting for recovery. So I'm glad you could all join us. So I'm going to jump right in just in the interest of time. And I know that we have very little time to cover a super important topic, which is really how to demystify this whole bank loan process. And I thought this was an appropriate, let's see if I can find it here. Let's see, I don't think I can find it anymore, but this, let me see if I can share an image with you. Y'all see that?
Yes.
Yeah.
Okay.
Yes.
So this is the banker wizard, and the banker wizard gives you a checklist and says, "Oh, you gather all of these ingredients and bring them to me. I need your financial statements and your tax returns and a personal financial statement, and bring them all to me, and I will determine whether you have a yes or a no." And that's, too many times I have spoken to business owners over the years that have said, well, I had a sort of a poor experience at this bank or that bank. And I would ask why. And they said, well, I went to apply for a loan and they came back and said no. And then I said, why? And they said, well, there's, not enough, you have insufficient cash flow, or collateral's insufficient, or there was very short sort of answers that went with that no. And so, the business owner went away going, well, I guess I'm not good enough, or I guess I just don't qualify. And those are, but I don't really know why. I don't really know how far off I was. I don't know whether I got a D, an F, a C minus, like I don't really know where I stand or how to fix it. There's never, there very rarely was there a blueprint given to how to get to a yes. So the crystal ball from the banker, becomes this really sort of scary thing. Quentin mentioned he had gotten turned down for a bank loan. Well, that makes you think twice about going back again. It doesn't feel good to get turned down. It doesn't feel good to have a good understanding of how to fix it or how to get, to a yes. So, I believe that empowering business owners to better understand the bank loan process will make them more ready to get that yes, to help grow their business, to help fund operations, to be more financially viable. And, we believe that when businesses are more financially viable in our communities, then they employ more people, they feed into the tax base, they support the other businesses. And so we end up with a much healthier community overall when our business community thrives. So this is kind of within our span of expertise. We try to help, as in this regard, try to help business owners be successful. So we have a very short time. I'm going to try to give you some useful tools that will help in this process. At any time, if you have questions, please put them in and we'll get to them. We're going to cover really 4 things today very quickly. I'm going to show you a couple of things, but we're not going to have the time to get into a deep dive. Many of you are going to be very happy to hear that. But I'm happy to then follow up with any of you after the call at a later date. We can get together one-on-one or in a smaller group and spend as much time as you need. First thing I want to talk about is cash flow or debt service coverage. Folks, no matter what you really hear out there, and I think, Brian Thomas is on the call and others will attest to this, is really the basis of any loan request has to start with an understanding of repayment. Banks don't really make loans anymore based on just collateral or just necessarily on a business plan. They really need to have some understanding of what source of repayment is going to be. Now, try to understand, David Deaton last month talked about a lot of different sources of financing. He talked about, venture capital. He talked about, other types of family and friends investment and whatnot. We're talking about bank financing here, and understand that banks make money with very, very low margins, right? They don't make a lot of money when they lend, but because of it, they can't take a lot of risk. And so you have to really tee up your loan request in such a way that the bank feels as comfortable as possible making the loan, knowing that the returns are modest, but loss is really, really devastating to the bank, right? Because the margins are thin. And so let's talk about what is the primary thing that they'll look at, which is repayment source. The beginnings of understanding what debt service coverage or cash flow coverage is to understand what your company's net cash to service debt actually is. And there's a term that's used in banking called EBITDA. It just stands for, it's an acronym. It's earnings before you add back the interest, depreciation, and amortization in your financials. And so what this gives you when you follow this very simple add them up, formula, gives you the net cash to service any debt that you might have, whether it's current debt or future debt. All right. And so when you go into a bank and you ask for a loan, that's considered a future debt. But you could have a line of credit that is getting ready to renew. You could have equipment loans needs. There's all kinds of loan opportunities, loan needs. But we need to understand first what your net cash available to service debt is. And just to give you just a high level on this, if you had $10 of net cash to service debt, and the debt service for the loan that you're asking for, or the loans that you have, is $5 a year, right? And you have $10 to service it, then you have a 2 times debt service coverage calculation, right? So you have twice as much available cash to service the debt that is proposed. So that's at the very simplest level. All right. And then where do you find that? So every business has a profit and loss statement or an income statement. And I'm not going to spend a lot of time digging into this. I'm just going to quickly show you where to find that acronym, where to find that EBITDA. All right. So in that financial statement, and they've made it easy, bankers love acronyms, EBITDA, earnings before. So we're looking for an E. Where does the E go? That's at the bottom of your financial statement. That's your net income, right? That's the earnings, E. In this case, depreciation is listed right above it. There's a D. I'm not going in any particular order here, but there's your E, your D. Amortization is the pay down on debt, right? That's in the calculation. That's your A. And then I is interest expense. So these are all items that when you add up the E, the I, the D, and the A, you end up with your net cash to service debt. And in this case, I did the math for you. I don't know if you can see the bottom there. Let me see if I can raise that up a bit. Is that easy enough to see there? And this is literally the way I would do banker notes, right? These are Dan's notes. I would literally add them up. I've got net income. I've got my interest. I've got depreciation expense, amortization, and I end up with, in this case, just for this particular income statement, $211,653 of net cash that I have available to service debt. Now, you know this now. Now that you know the formula, you will know what your net cash to service debt is before you walk into the bank, before you make application, all right? No one has to tell you this now. You know what it is. Now, on your proposed loan, I just stuck it over in the left side here. I just did a hypothetical loan. This is an equipment loan. This could be a couple of trucks. It could be, it could be anything. We did a simple calculation over a 60-month period or a 5-year loan, $4,600 a month or $55,200 a year. Just that's a hypothetical loan request. When you plug in that $55,200 and drop it drop it down below your net cash to service debt, and you divide your net cash to service debt by the annual proposed debt service, it gives you a debt service coverage calculation. In this case, it's 3.83 times. Now, most banks want to see at least a minimum, and it varies from bank to bank, but most banks will want to see at least 1.25 times debt service coverage. I've seen some banks that like it as high as 1.75. The truth is usually somewhere in between, and it depends on the bank, but most banks follow fairly standardized or fairly typical sort of underwriting guidelines. I would say the average that I've seen, and Brian and Paul and others might have some other thoughts on this, but it's typically about 1.25, 1.35 as a minimum. So when you go in, if you look at your own financials and it's below that number, just know that it's probably below where most banks would like to see it going in. Of course, there's always exceptions to the rule, but that's typical. So in this scenario, this is a happy smiley face. Happy smiley face at 3.83 times debt service coverage. At least I feel like the banker's not going to criticize me. He's going to think that cash flow or debt service coverage is a positive. You also may hear the term global debt service coverage. A global debt service coverage takes your business, does it exactly the way we just did it, the way you're looking at it here for your business, and then it adds into the omelet, if you will, the ingredients of your personal or guarantor side. So if you are a single owner business and you're applying for credit, the bank may also look at global debt service coverage. It'll add in any other income that you might have through your personal investments or through other businesses that you might be receiving distributions on, or maybe you have W-2. And we have a lot of businesses that have a professional career that they've had for many, many years, and then they have a side business. And so we will take into consideration the income that comes from other sources into that global calculation. You also with that have to take in the debt. So if you also have a mortgage and if you have a bunch of car loans, all of those things are also going to go into the omelet and create that global debt service coverage. Sometimes that's a positive and it helps the calculation, and sometimes it hurts if you have big spending habits, big debt, and and then that global may worsen the calculation, if you will. We've seen that both ways, and it just depends on the situation. So I want to just show you quickly, that was on an income statement. Some of you may file your business income on a Schedule C, on a personal tax return. So where do you find those same numbers? Here's a Schedule C, if everybody can see that. This would be on a personal tax return where you're filing for your sort of closely held business, and there it's labeled just as it would be on your income statement that we just looked at. So here's on part 13 is your depreciation. There's your D. In this case, there was none. Below that is interest. There's the I. Amortization isn't so clearly marked here. And so your earnings of $81,279, you add back the I, the 8,092, the D, there's no add back, there's no amortization expense. So you end up with total cash flow to service debt here of $89,371. And just using the same loan that we had on the previous page where it had $55,200 of debt service, that's now a 1.6 times for this person. This is a different company, a 1.6 times debt service coverage. So are we having happy faces or sad faces on this one? Yeah, happy faces. We're still over that mark. Now it's possible the bank may not like the 1.6. They may want a 1.75, but I think in most cases, if you're above that sort of 125, 135 mark, you're kind of above the waterline. If you file, a separate tax return for your business, most likely it's an S corp if it's closely held, and so it lines up a little differently here. There's one little nuance on federal tax returns, business returns. Most banks start back in the tax return. On this page, it's called the M1, M2 calculation, and you don't need to know much about this other than that this number takes into account some balance sheet adjustments from prior years, takes into account certain accumulated or accelerated depreciation, things of that nature. So most banks start on this page, not the front page, to get that E, right? The net income or the earnings. I'm going to go back to the front page now, though. Now that we know where we're finding our E, in this case, line 13, the I, there is no interest expense. Line 14 is the D, that's the depreciation. Remember, all these are marked. It's really easy just to look over to the left and see what line we're looking at here. You got $4,545 of depreciation, right? And then on this page, a little extra depreciation. When the recession hit, has anybody heard the term 179 or Section 179 depreciation? This was something that the Fed put out there to try to help businesses sort of reduce their tax liability, and it allowed companies to take accelerated depreciation on equipment, real estate, things of that nature. So companies would take advantage of taking a lot of depreciation up front instead of over a long period of time, and it was supposed to help them get through sort of tough periods during the recession. A lot of companies are still employing 179 depreciation. So you got to kind of look for it, but we found another 22,000 of this Section 179 depreciation. I don't want to lose anybody, so I'm going to move forward. There's some amortization that's listed here. And at the end of the day, when we get back to this page, the same calculation you saw before, it's net income, or the E, add back the interest, the depreciation, amortization. And in this case, we end up with $138,728 of net cash. I used the same loan as before, just for the example, 2.51 times debt service coverage. Are we happy? We're happy. And you should know that you should not have a cash flow problem when you ask for this loan, because your debt service coverage is over the watermark. All right, that was through a lot of you. That was the most numbers I'm going to throw at you. I wanted to get you while you were still fresh. But let me just stop there and ask if there are any questions on what you've just seen, or that calculation.
Well, Dan, if there aren't any questions or someone's still formulating, one thing I wanted to mention to you or ask is, like with the example that you used, that the business was like a $1 million revenue generating business. Could you share with us that may not necessarily define, I could look at that sheet and say, well, I don't do $1 million a year.
Mm-hmm.
So this doesn't apply to me. So could you speak to that point?
Sure. It's the same calculation, just take a digit off of it. So in this case, if it was net income on the screen that I'm showing now, if net income was $10,156, right? And the depreciation was $454, and so forth. You could just take a digit right off of the end, and it's the same calculation. And that's where folks start to get sort of mystified about how I'm only a $200,000 business, or I'm a $75,000 business. Like, how would I possibly qualify? Well, if you're a $75,000 business that's making $10,000 net at the end of the day, or $20,000, and you go and ask for $250,000 of debt, the banker's probably going to look at that cross-eyed, because there just isn't enough cash flow to support the debt, right? So it's the same calculation, and that's where I think folks sometimes, get sideways, is they don't think they're big enough for a business loan, or they don't, they don't think they need to understand it more, because I'm not a $1 million company. But every company has an income statement. David talked about there's three things, right? In his last session last month, you got a balance sheet, you got an income statement. Some folks at the lower level will have a cash statement of cash flows, but really the balance sheet and the income statement are the ones that, if you're using QuickBooks or using some accounting software, or you're just doing it on an Excel spreadsheet, at some point you list how much you make, how much your costs were, and how much you make at the end of the day, what your net income is. And that's, if you have those numbers, right, you can figure out what your net cash to service debt is.
So I have a question. I was wondering, so I was in mortgages. I helped people get mortgages back in the day. And I was wondering, when we talked to people, it would be 3 years of income when they were in, when they had their own businesses. So when you're looking at a bank loan for your business, how many years of income at a solid level? Like, do you total everything over a certain amount of time, or are you just looking at the latest year's tax returns?
Yeah, I think the latest years, to answer that in a couple parts. First of all, there's a lot of there are some differences between the consumer lending space and the commercial space, right? So, it's all highly regulated stuff, but the consumer regulations are ridiculous now. And I don't mean that, it's just a lot. The assumption is that borrowers need to be protected, and the Consumer Financial Protection Division spends a lot of time thinking about how to regulate lending institutions to make sure that they don't take advantage of people, or that people are fully informed. And that's not a bad thing. It's just, there's a lot to it, and it's not as highly scrutinized in the commercial space. During the recession, the Fair Lending Act and the ability to repay law within the Fair Lending Act made it onerous on the lending institutions to never make a loan that you could not justify the source of repayment. And we started this off by saying, you know, the first thing that any bank's going to look at, and this is for commercial or consumer, is going to be source of repayment or the ability to repay. If a bank makes a mortgage loan or a loan to a business that clearly could not be justified from a repayment perspective, you know, the bank can be fined a lot of money. And so the banks and the lending institutions and the mortgage companies just not interested in trying to go out there and make those loans that, you know, that maybe feel good, but you couldn't justify it anymore. You know, so you got to be really careful with that. The answer to your question specifically on timing is, in the commercial space, it could be as little as 1 year. If you have a business that's done well, it's been around for a year. I mean, the standard answer to that, and you know, if Brian wants to chime in, or Paul could, I mean, it's typically 2 years in business, or have 2 full years is kind of a nice amount of information to have. And then the most recent full verified year, that's either verified through your taxes or verified through like a third party CPA financial statements, reviewed or audited statements. The most recent full year is probably the most important, because it gives you a sort of a verified amount of cash to service debt, right? So if you have 6 months of the current year, it can give you a trend line and you can annualize it. But if it's a seasonal business, is that accurate? Is that 6 months really accurate, really indicative of what the full year is going to look like? Also, you know, a lot of people at the beginning of the year in January had they were off to a great start. And then things that were outside of their control, namely a pandemic, completely changed things. And so, you know, the last full verified year is typically the most leaned upon numbers. But trend line, Sarah, is really important. So, you know, if you had a year last year that looks good, or at least is close to that underwriting line, that 125 or that 135, and then the current year might have, you know, here we are in, you know, we're in September now, so you might have 8 months through our August of numbers, and they look like you're continuing a positive trend line. That's really a good story to tell. I mean, that's really shows that things are progressing in the right direction. Thank you for the questions. Are there other questions on that? The other sections will move faster, I promise.
Yeah, there were 2 other questions, I believe, from Michael, one from Michael and one from Libby.
Okay.
Yes, so Michael's looks like it clicked for him. So I'll do Libby's first, and then we can circle back to Michael's. Libby's question was, how do small businesses start getting credit in the name of the business and not just their personal credit?
Yeah, that's a great question. I mean, some small amounts of credit in the beginning that are appropriate for the size and the age of the business can happen fairly easily. Small lines of credit, small credit cards can be issued to a business. And keep in mind that everything you do for a closely held business, it is intrinsically linked together. You know, it's very rare that a business under 5 million, I would say, gets away with having the business sort of stand alone without the backing of the owners of the company. And, you know, the quirky kind of response to a bank that gets the question, well, you know, can my business stand alone? Do I have to guarantee it? Is, well, why wouldn't you guarantee it? Like, you're asking us to go in and lend you money, and you're not willing to stand behind the company. And so, you know, I know it's not a great answer to hear, but it's really the truth. The banks get very nervous when a company of, you know, especially a closely held company where you've got, you know, family ownership or ownership in 1 or 2 partners. You know, they're very active in the business and not just investors. They've got more than 20% ownership in a business. Like, why wouldn't that person want to put their name on that loan? And remember, the banks typically make about 3 to 3.5% on lending. It's not sexy, right? And so you can't take a lot of risk. And if the owner is expecting to make 15, 20% a year on the operations of that business, and they're not willing to sign anything, it's hard to break that apart. Where you do see that that separation of the management and separation of the business is typically a nonprofit lending. You know, you don't have any owners of a nonprofit. You've got a board If you belong to a religious organization, a church, a synagogue, they typically you don't typically have guarantors on those loans. It's a little harder to lend to a nonprofit than it is because of that very thing. You don't typically have people standing behind it necessarily that benefit from that relationship. And then when you have companies that are, owned by, you got 50 different owners that all have, 2%, 3%, it's spread across the board. There's no real one owner, if you will, or majority owner that has a meaningful ownership percentage. And in those cases, the business better be strong. It better stand alone. It better, be above all of the underwriting criteria. And then it's absolutely possible to lend without guarantors. But and just so you have the terminology, a loan that's done without guarantors, individual guarantors, is called non-recourse. Bank has no recourse, right? It's the business stands alone, and that's it. And maybe you've got collateral, which we'll talk about. But for the most part, it's a non-recourse loan, not loved by banks. What was the other question?
The other one had been wondering why it would be that having a large amount of depreciation and interest actually increases your DSC. Like, why would that help you get a loan if you already have so much depreciation and interest?
And I'll just voice that a little bit. That was my question that I had. It seemed like, if you have a huge amount of depreciation and you have a huge amount of interest that's being taken out of your net income, I don't quite understand why that's being ignored when the bank is considering, should you get another loan, can we trust that you'll pay that loan back when, say, most of your revenue is already going towards paying down existing debt that you have?
Yeah, sure. So depreciation and amortization really are, depreciation for the most part is a tax planning tool. It's a non-cash event, and if you put it in there, it's designed to decrease your tax liability because your assets are depreciating, but it's non-cash. So we give that back to you in that calculation. So remember, we're adding back depreciation. Interest, we're going to recalculate that interest expense and the amortization when we build the new loan, because the new loan, we don't just say, well, here's the interest expense on the new loan. We say that if you're going to pay X number of dollars per month, that equals $55,200 a year. That's principal and interest. And we may add other loans that you already have into that calculation. We don't want to hit you twice for that. So if we don't add back the interest and the amortization, then you're technically getting double nicked for the same expense items. And so that's why those are the typical add backs. We've had companies that take extraordinary Section 179 depreciation, and it, basically takes their whole net earnings down to zero, sometimes less than zero. Right? I've had companies with $1 million of negative, net income for the year. They've lost $1 million, but when you start adding back these add backs, you realize they might have made money in the end of the day. But that's a tax planning tool. A lot of times in your income statement, Michael, you won't even include depreciation on your income statement. You won't have amortization. You usually have interest expense, but a lot of times it's not even included there, and you don't even start talking about depreciation until you start doing your taxes. So on an income statement, it may not even be there. And I'll ask the question sometimes, hey, are you expecting to take any depreciation? Now, if you ask that question, it would be an add and a subtraction. So it's really irrelevant anyway at that point. But on an income statement, a lot of times realize that you're not even talking about that yet.
Got it. Thanks.
Okay. Does that cover our questions on sort of this? Guys, I know there's probably more questions that you might have in your head. I'm happy to discuss them. I'm going to get everybody's email, or you'll have my information. And any time you want to just sit down and have a cup of coffee and just talk through your own financials with no expectations and no obligation or anything, we could just have a good conversation about it. Let's talk about collateral for a second, if we could. Listen, collateral is a secondary source of repayment. So if you can't satisfy that first piece, you got some issues trying to get a loan. Now, so just a couple things quickly on collateral. It can be all kinds of stuff, right? It could be inventory, it could be finished goods, something you make and you store on your shelves that you're going to sell. It could be something that you store and you get ready to ship out to others, like finished goods inventory. It could be accounts receivable. You're a firm that performs a service and then you bill out. And so that billing before you get paid is called accounts receivable, right? That's an asset. I mean, we do a lot of lending that's just on accounts receivable. When we like what the business is doing and the cash flow is good, accounts receivable could easily be collateral for a loan. Love real estate. It's hard for real estate to go out the door. Real estate of all kinds. You can have commercial real estate. You can have land loans. You can have primary residences, secondary residences, equipment loans of all kinds. Your bank might have specific favorable feelings on doing certain types of loans. They might not like doing accounts receivable lending. They might not like doing equipment. We'll talk about fit a little bit before we break today. Cash and marketable securities can also be a source of repayment. And you might ask, well, okay, if I've got the cash, why do I need a loan? Right? Or if I've got marketable securities, why can't I just break them up and use that for a loan? Well, that can be costly, could be expensive, and it might not sometimes be your cash or your marketable securities. There are times when somebody who's a family friend or somebody that's just a beneficiary of that company or an investor in the company might say, well, in order to entice the bank to make a loan, I don't mind putting up my assets, but I don't want to just give that company, $50,000 in cash, but I'll put it into a CD at the bank and let the bank use that as collateral, and then the bank can make a loan to the company. And back to a question that was asked earlier about when can you break apart a loan that doesn't include the individuals, it's just a loan to a business. A lot of times the way to accomplish that is by using liquid collateral for the loan, either cash or marketable securities that the bank can put a hold on and then can convert that cash immediately is the key word, can convert it into repayment on the loan. Real estate, equipment, accounts receivable, inventory, those are harder to turn into cash for a bank. It's easy for the company. That's what they do. They make tuna fish. They sell tuna fish. They convert tuna fish into cash. If a bank had to do that, we're bad at selling tuna fish, right? We're bad at doing a lot of things. So the collateral can be used as a secondary source, but it's not the primary source of repayment. When everything else looks not so great, cash and marketable securities can always be used to make a bad loan look good, though, because the bank's taking on very little risk in those cases. Okay. So every one of these types of collateral gets margined a bit. Real estate, banks don't typically do 100% of the value of real estate or equipment or inventory. Like, they always will haircut it a little bit because, again, we're bad at selling those things. And if we have to liquidate them, we're going to lose money. It's the question is, how much will we lose typically? We don't want it to be a lot. So we don't start off by financing 100% of really anything. Typically, I'm not saying there's not exceptions to the rule, but the general reality is that banks are going to margin or put a loan to value of some kind, a haircut against collateral. So I'm going to move off of collateral. Is there any questions on collateral? The biggest thing to know there and to keep in mind is it's a secondary source of repayment in most cases. And so just having a lot of collateral will not get you your loan.
We do have one question, Dan. Can you use life insurance policies as collateral?
Yeah, cash value life insurance, I could have included that here. I probably should have, but if it's not the face value of a policy, but the cash value. So a lot of people have, $500,000 life insurance policy that has, some cash value that builds up over time. Only the cash value can be used as collateral. And also on the securities piece, the Fed does not allow for banks or lending institutions to lean up against IRAs or 401ks or any qualified retirement plans. So those marketable securities have to truly be like in your trading account, but it can't be in your retirement. Bank has to be able to get to it without restrictions. Good question, though. Any other questions on collateral? I'm going to race through the rest.
There's a little actually.
Okay, great. Going to quickly talk about leverage. Banks do get concerned about the amount of debt a company acquires over time or has on their balance sheet. I know Dave talked about leverage a little bit in the last call, so I don't want to belabor this point, but we use a ratio called, sorry, I need more coffee. We use a debt ratio. The leverage ratio is typically going to measure the net assets or the equity in your company against its total debt, and it's offered up as a ratio with the debt first. So if you have a company that's got, in this case, I gave an example. It's got total liabilities, total debt, and this could include the debt that you're asking for. So if you had 80,000 already in debt and you're asking for another 20,000, you would have $100,000 in total debt. This is not the debt service. This is the actual amount of debt that shows up on your balance sheet. So if you have 2 trucks, they're $50,000 worth of loans each, you have $100,000 of debt. And if the net worth of your company, when you look at your balance sheet, if you look at the equity or the net worth, that's all of your assets on the top and all of your liabilities down below, and then what's left over that's your net worth, right? Sort of like if you owed $1 million, if you had $1 million home and you owed $500,000 on your mortgage, right? You have $500,000 of equity. That's your net worth of the house. That's the equity in the house. Business is the same way. So in this scenario, if you had $100,000 in debt and you had $50,000 in net worth, that would be demonstrated as a it should be 2 to 1, not 2 to 0 here. 2 to 1 ratio. You've got twice as much debt as your equity. So that should be a 2 to 1 ratio. On a balance sheet, you have all of your liabilities. This is a 2-page balance sheet. Here's your liabilities of $174,572 in this case for this company. These are all different companies. Total liabilities, your total assets.
Dan, could you make it a little bit bigger?
Yeah, sure. Sorry about that. How's that? A little better? So total assets on the front page or on the top, if you have a 1-page balance sheet, 232,000 of total assets, $174,000, 174,572 of total liabilities, leaves a net worth. There's some other additions and subtractions down here, but your equity or your net worth in this case is 58,314. So that's the net worth of the company. You go back to those total liabilities of 174,000, and that creates your ratio, right? So you now have a ratio of approximately 3 to 1. Banks will start getting nervous with your company, and it's a little different depending on what kind of company you're in. Some equipment-intensive companies, trucking companies, excavating companies, construction outfits have a lot of vehicles. If you're you run a plumbing company and you've got 20 vehicles, 10 vehicles too, like they're equipment-intensive, they tend to have a little higher debt to worth or a little higher leverage ratio. But any company that starts getting much more north of 4 to 1 or 5 to 1, it starts to make the bank worried about the amount of debt that your company is carrying and whether or not adding more debt with your new loan request is appropriate. It's a little bit about capacity. If this person were to liquidate their assets, their net, this part of their net worth. David, I think, used the slide about the dam last month, and you want to put stuff up in the lake, right? So there's stuff to go over the dam when times are tough. The leverage ratio kind of speaks to that a little bit. Do you have the capacity to weather the storm if things pull back in the economy or if things start to go bad? So again, we're running out of time here, but leverage is a balance sheet transaction, a balance sheet calculation. And, a bank will look at that leverage ratio just to make sure you're not getting a little bit too far over your ski tips, if you will. Any questions on leverage?
Dan, we do have one question, which might be a little bit in the leverage. It was asked prior to it, but will a bank finance a project at 100% loan to value?
I mean, there's always exceptions to the rule, but the answer for that is no. Why would the bank want to take? Remember, the bank isn't in it for risk, right? We have to take low risk and low reward. not high risk, high reward. So if the borrower doesn't put some skin in the game, we do a lot of SBA lending. These are guaranteed loans. The federal government guarantees certain loans for us to help entice the bank to make loans. Even in those cases, you very rarely will get to 100% financing. Typically, a minimum injection from a borrower might be 10%. Skin in the game, right? What's to stop that person from just giving up and walking away if they have no skin in the game?
So what you're saying, Dan, is it's okay for total debt to be a couple, 2-3 times your net worth in the company, but for the whatever project you're borrowing money for, the business needs to put up some of the money for that item.
Yeah, the business or the borrower, themselves, the individual or the guarantor. In some cases, somebody owns another piece of property outright and they want to buy a new one and they don't want to put any money in. Well, if we had both of those properties as collateral, now there's equity, right? Because we have this other property that has no debt against it or has little debt. We put that into the formula, right? We have this other piece of collateral, and now technically we're not at 100% financing anymore because we've collateralized another asset. There's ways to get there, but typically, even in those cases, Don, I'll be honest with you, banks don't like to see borrowers put $0 into a project. I don't know if Brian wants to opine on that. Brian Thomas is on. I'm not sure if I can't see if Brian's still with us or not, but I think most lending institutions want to see some borrower contribution. Just want to talk on credit character, if I can. So credit scoring is important. Your credit, your institution that you're talking to, your bank that you're talking to, every bank has a different sort of cutoff for what they consider to be high credit score, low credit scores, unacceptable credit scores. I will tell you that it's different across the board, but what I've seen generally is a 660, 680 minimum credit scores and above. When you start getting into those credit scores that are toward the lower end of a bank's comfort level, I think it's really important that the banker be a banker and actually look at the credit report and not just look at the score. There are some instances that are worse than others. There's bad repayment, right? And then there's having, for example, a lot of debt. Like sometimes having high balances on credit cards, for example, can be very detrimental to your credit score, but you pay everybody on time every month. You've never been late. One speaks to character, right? This person obviously pays their bills, but they've got a lot of credit. And maybe what you're talking about is going to take some of that personal credit card debt off of their personal balance sheet and put it into the business where it might have belonged in the first place. So I guess what I'm trying to say there is a good banker will dig into the credit report. Typically if your credit score comes in and it's 780, no one's going to scrutinize it very much. They're going to be happy they got credit checked off and they're going to move on to the next piece of underwriting, one of these other 4 items. If you do have a poor credit score, but it's nothing really damaging in there, if you've got no charge-offs, no collections, make sure your banker is looking at that and understands why your score is. Sometimes there's also good stories. I don't mean good stories, but there are reasonable stories. Let's say somebody went through a bad divorce a couple of years ago, it destroyed their credit, or they had an instance of credit fraud. There's a story to be told sometimes, and make sure your banker is open and willing to at least listen to the story. Also, I would tell you that there's nothing better than having a good repayment history with the lender you're talking to. I've seen some situations where, we've looked at a credit and it's been a little marginal, not awful, but maybe right on the line, but they've repaid us with everything that they've asked us for in the past. And their repayment history is solid with us, even if they've got some credit issues outside of our bank. We will look at that and that relationship and give some credit for that, because that's meaningful for us. And then I'll hold off on your questions for credit for a second. I'm going to just include 2 other things. There's no slides for this, but when you're coming to your bank, and this is super important, guys, the simpler your story is about why you're asking for credit, like your loan request, if there's a very reasonable and simple sort of explanation for why you're asking for credit, that's always going to be give you an easier path to success than if your business plan or your request is really convoluted. It has 25 different moving parts. It's all based on, speculate. Oh, look, I believe if I do this, this will happen, and then 5 other things will happen, and then in 2 years we're going to get paid. Like that. Those are harder stories for bankers to digest than you coming in. You have a plumbing business. You want to get a line of credit because you're waiting to get paid by others. You want to put another truck on the road and hire another crew because your business is growing. Staying within the sort of parameters of your historical business or your line of work is kind of makes a bank feel more comfortable that you know what you're doing and you're just expanding on operations. So the more simple the story, the better your chance for success. That's not that bankers are stupid or they're lazy, but they typically like a simple story. They might have to tell your story to others. They might have to tell it to a loan committee or to an approving officer somewhere else. And if you expecting somebody else to tell a complicated story for you, good luck, right? That's hard. And then the last thing is just fit. It's okay to ask your banker before you start to apply for a loan and ask, does your bank like this type of loan? I'm getting ready to do this project, or I'm getting ready to expand this business, whatever it might be. I'm getting ready. I need to buy some more equipment. Does your bank like to do equipment lending? If your banker or your bank tells you that, yeah, we do it, but it's not really something that we pursue, they're going to have a much more critical view of that request than if it's something that they like to do and that they're good at and that they're very comfortable, sort of providing credit for. So it's okay up front, save yourself some time, ask your banker if they're good at that. And if they're looking for that, and if they're not, maybe they can give you a referral to a bank or a banker that is more comfortable doing that type of lending. All right, I'm out of time. Why don't I stop there and just take as much time as you need? I know we're over 1, but I'm willing to stay, Quentin, since we started a little bit late. If there are questions, I'm happy to just remain on the line.
Well, thank you very much, Dan. I know we have some questions that are coming in, and I would love to check in with Andrea to see, because I'm enthralled. I'm at the edge of my seat. I could listen for another hour or so. I've posted questions. I think some more questions will be coming in. So if you're willing to stay on, I'm willing to stay on.
Sure.
I want to make sure Andrea is available to stay on. But please take the opportunity to pose your questions. It is now 1:06. I appreciate you staying on, Dan. But
Sure
if anyone has any questions, would like to stay on, we can stay on for another 15 minutes or so, if Andrea doesn't have to move on to another meeting.
So it looks like Andrea is on. So I'll go ahead and ask. We have 2 questions that came in already.
Great.
So first was from Quentin. With the large amount of financial institutions out there, how important is it to choose the right type or size bank? Or how should a business decide what type of bank fits their business model and size?
Yeah, I want to be careful with this, because the reality is that there are good bankers at all size institutions. And there are a lot of really good banks out there. And when it's working the best is when your banker and the bank are in lockstep with each other. I've seen a lot of circumstances where, you might tell a good story to your banker, and your banker may really want to help you with that loan, but the bank doesn't agree. Like the underwriting philosophy, the risk tolerance, the fit is just not there. And so I've also seen it where, the bank would love to do more loans, whatever bank it is. I've been with a bunch, and the banker is just not equipped, just not experienced enough, they're just not savvy enough to dig through